So we are setting the stage. We're taking a journey through risk and resilience, which is the name of this next session. I want to start with the WEF's Global Risk Report. And joining us via video, Sadia Zahidi, Managing Director of the World Economic Forum. Hello, Sadia. Thanks for joining.
Thank you very much for inviting me. I wish I could have joined you in person, but I hope that this overview of the Global Risk Report 2025 will be a useful contribution to your discussions. In the Forum's Global Risk Report this year, we asked respondents to assess the likely severity of global risks in 2025, over the next 2 years to 2027, and then over the next decade through to 2035. We looked at the full spectrum of macro risks: societal, technological, economic, environmental, and geopolitical. There are a number of different findings, and I'll try to summarize them. First of all, just declining optimism. So overall, nearly 2/3, that's 62% of respondents, predict a stormy or a turbulent outlook over the next 10 years, compared to only about 1/3 over the next 2 years. So if we think pessimism is high now, there is an even stronger sense of pessimism over the next 10 years. The second finding is that conflict is the leading concern, both in 2025 and over the 2-year time period. So as already identified in last year's report, we appear to be experiencing a paradigm shift in the world order characterized by greater instability, polarizing narratives, eroding trust, and insecurity. State-based armed conflict emerges as the top immediate risk, identified by 23% of respondents, reflecting heightened geopolitical tensions and fragmentation globally. Vulnerable and low-income groups often suffer the most during conflict. And moreover, as conflicts lead to a greater focus on security and defense spending, there's often declining funding for development and humanitarian issues with generations-long consequences. The third finding is around misinformation and disinformation. That's, again, the top-ranked 2-year risk. Mis and disinformation is fueling instability and undermining trust in governance, complicating the urgent need for cooperation to address shared crises. False content is a persistent threat to societal cohesion, exacerbating divisions within and between nations and contributing overall to societal and political fragmentation. New technologies such as generative AI are making it easier to create and distribute dis and misinformation at scale. Where literacy, and in particular digital literacy, is low, such mis and disinformation can sow discord. Our fourth finding is that environmental risks still dominate the long term. When it comes to the outlook for the next decade, environmental risks dominate that 10-year horizon, led by extreme weather events and biodiversity loss and ecosystem collapse. Pollution is also back in the top 10. It's the largest environmental risk factor for disease and for premature deaths, and its impacts are unequal, with 92% of pollution-related deaths and the greatest burden of related economic losses occurring in low and middle-income countries. Our fifth finding is that societal risks are the most interconnected. We also asked respondents to highlight relationships between global risks, and our findings show that just how exposed low-income populations are to the global risks landscape. We found that the most interconnected risk of all is inequality. It's connected to economic, environmental, technological concerns, but also to other societal risks, including decline in health and well-being and societal polarization. Now, looking ahead, we do need to manage this uncertainty, and we do need to foster resilience. When it comes to management of and resilience to risks, this growing global fragmentation is weakening the kind of multilateral collaboration that's required in many fields. So first and foremost, we must continue to focus on cooperation. The world may be more fragmented, or its leadership may be more fragmented, but the risks are more interconnected than ever. Trade and climate and technology are all going to require global cooperation. At the same time, we do also need policies that strengthen the domestic economy and build societal resilience locally. And that includes inclusive financial sector development, education, health, public awareness, and digital literacy. Global risk can be well managed and mitigated if visionary leaders step up to build common ground, build compromises, and create mutually acceptable solutions. By deepening honest dialogue with each other, we can rebuild trust and act together to create stronger, more resilient economies and societies. Thank you.
So what are we looking at in this panel conversation that you're about to hear? The changing risk landscape, the complexities of the issues, and some really innovative strategies. All right, I want you to make them feel very welcome as they come on stage, because they have taken on that responsibility to be the catalyst to start a deep and exciting conversation. Stuart Rutherford is director of Hirschparer Daily Diaries Project. Stuart, there's a seat on the stage waiting for you. Please join us. Shamina Singh, founder and president, MasterCard Center for Inclusive Growth. I feel like we need walk-on music. And Magda Bianco, head of the Directorate General for Consumer Protection and Financial Education for the Bank of Italy. Panel, your microphones are on. You cannot turn them off. Trust the process, and they will work. All right, so very quickly, it'd be really good to know, in your separate and individual endeavors, where does resilience come into your work? So as you're talking, we understand the connection. Magda, you start.
Thank you. Well, I deal with consumer protection and financial education, so the connection is there, immediate. They are enablers of financial inclusion and resilience. But I'm also co-chairing a G20 Global Partnership for Financial Inclusion, and there we really deal with financial inclusion and its role for financial health, financial well-being, and hence resilience is there.
Mm-hmm. Shamina.
So I have two hats that I wear, I think, when I think about resilience. One is as the head of the MasterCard Center for Inclusive Growth, which is social impact, philanthropic engagement. The second is sitting inside MasterCard, which is a payments network, a payments technology company. So I think for resilience, if Magda is on the regulatory, the public sector side, I would sort of say we're on the private sector side. So our interventions are really around products and services. So if you buy something, you should get what you pay for. And if you don't get it, you should get your money back. That's the sort of resilience on the private sector side. And then partnering with organizations like many of you in the room to ensure that you remain resilient in the face of all of these challenges.
For me, as an observer, I'm someone who's been doing financial diaries for many years, and part of that work is to understand low-income populations, what their aspirations are, what their own resilience is, how they manage. My main fundamental interest is how do poor people manage their money, and do they use their management of money to make them more resilient or not is a very interesting question.
We posed some poll questions, Magda, to our audience about EMDEs and what is the biggest risk for them. If we're looking at government supporting EMDEs, how do they do that? How do they give greater resilience as the world is getting more and more difficult to navigate?
That's very important, a very difficult question. So I will try to answer in general terms. We heard a lot about the risks. They are getting interconnected. They are getting huge. They're very hard, and they are very hard to predict. So the uncertainty also to predict them creates a lot of problems. We heard about misinformation as one of the first. So that creates enormous difficulties even for governments, but also for people. And also the more limited availability of direct financial support is a big thing. Now, the areas that I see as important for governments are, if I were to put them in progress, I would say first, try to recognize and evaluate these risks for the country, for the population, for the segments of the population, how they're going to impact them. This means having information, dealing with information, which is already a challenge, of course. We now have greater availability of detailed, even micro information. We have the Findex data set that's coming out soon, the next one. For Africa, we have the southern part of Africa, we have FISCOP. So this might really help to direct, analyze the impact of the challenges. Second, I would say again, in general terms, plan. So as much as possible, after analyzing what are the challenges, try to deal with them with a medium, longer term horizon so that you are not trapped in the emergency, reacting to emergencies, which sometimes, of course, you have to do, but then you're trapped in the vicious circle. As much as possible, try to plan in advance to have the instruments to deal with them. And third, of course, there are the instruments, which are the ones, again, if I had to prioritize, I would say start with infrastructure as much as possible, whenever you have enough funds. Of course, physical infrastructure, public digital infrastructure, digital IDs, but also immaterial infrastructure, such as having a very solid rule of law, invest in education, of course. Second step is, investing in the environment, the regulation and environment that drives a good financial sector that's really producing inclusion. And for this, I think, again, there are various steps. One is building on innovation, but also governing it, because we know that innovation can produce a lot of inclusion. We have a lot of digital, but even going beyond instruments that can help support the financial sector to drive innovation. But we know there are a lot of risks. So we really need to govern innovation that has to go in that direction. And to do that, we need regulation, good regulation. We heard this morning, well, not this afternoon, some of the elements. We know quite a bit about good regulation for the financial sector that has to create safety, solidity, but also trust. This means having solid consumer protection, enforcement of consumer protection, again, another challenge, because you have to be able to enforce, and you have to have financial education, because you need to build a sort of circle around it. A lot of challenges, of course, there, because you need capabilities, you need data, you need enforcement structures, and you need financial resources in some sense.
Right, so I hear this. This is like the perfect ideal blueprint for how government can support EMDEs in their resilience challenges. Shamina, I love when the private sector are in the conversation, because you just operate differently. It's like you're wearing capes, but your capes are invisible, because you can cut through all of but we can't do this, and you just get it done. But when you're looking at this changing landscape of resilience, what can and is the private sector doing to support EMDEs? How are they changing the way they're operating? How are you changing?
So here's the thing. So I think we can all say we're friends here, because I've known many of you since we started this work 15 years ago. And so these are not new concepts for any of us. The acronym may be new, but the concept of what we're trying to do is something we've all been working on for a long time. So what's exciting for me about this conversation is that CGAP, which honestly I will say without sarcasm, is and I say this to them too, is this is the few groups that actually read. Like when CGAP comes out with their newsletters and their research, I actually read it because it's actionable. And that's the difference between a lot of what we're talking and hearing about, is that, and maybe what you're talking about for private sector engagement, is that all of this stuff has to be something we can do something with. And so when I read this and when I come here, I'm listening for the theoretical, to be sure, but I'm listening to the so what and the when and what can I do. And I think as we think about resilience in particular, I can't talk for the entire private sector. I can talk, well, is Garance still here from AXA? I can talk for Garance too. I don't think she's still here, but Garance was here from Allianz. And so But she and I have been on this journey together forever. So Michael Schlein and I have been on this journey forever. Helena and I have been on this journey forever. So it takes everybody. It takes, people use this term ecosystem way too much, I think. But but I think what's underneath that is the idea of complementary assets. It takes private sector to do what we're doing, and I can talk a little bit about that, but it takes every bit of everybody in here to make sure that this thing is going to work. And so that means everybody has to be excellent, and everybody has to be operating with a level, with standards. And so with my regulatory friend on the panel, one of the things I talk about is regulation is not only for private sector or even public sector. Regulation is a set of standards that we all adhere to, whether they're mandated or not. And so in this type of environment where technology is moving so fast, where things are happening so fast, we have to have a sense of standards, with or without, always with the regulator, but it has to be our operating model. And so that's the first thing I'd say is private sector operating with a sense of, we call it customer centricity. The standard is it has to be outcome based. Is this actually helping the customer? Sometimes the customer is a small business. Sometimes it's an individual. And sometimes it's the intermediary. And I will give one example and then move on. But because we have Michael Schlein in the audience, I think one thing for us to think about when we're thinking about resilience is to ensure that you all are resilient as the intermediaries. We started a project 2 years before the pandemic called the MasterCard Axion program partnership. But the idea was that in order for MFIs and the Axion network to be resilient, to be effective, we posited that they had to digitize quickly. Now, this was 2 years before the pandemic. So we embarked on a program together where Michael and Pratik is here as well, but that the Axion, and Kathleen is here, who, by the way, was our first intern at the Center for Inclusive Growth. So, but we got together and said, what's it going to take for MFIs to digitize at scale? And guess what? It wasn't a digital tool. There was no such thing as a silver, and it still isn't a silver bullet. It was a set of, boards had to make decisions, bylaws had to be changed, culture had to be changed, their customers had to, there was a whole set of things that were required. 2 years in, and I don't know, $15 million later, COVID hits. And who's ready to go? Who's prepared? The Axion network had been part of this digitization program. That's resilience at work. And what is the private sector, sort of the sustainability model post? We did the first set of investments. Afterwards, Michael and Axion created a new fund that has now become self-sustaining to help all microfinance institutions digitize and upskill. But now the digitization is called data, too. And so now we're thinking about AI and the technology. But that's just an example of sort of saying, look, if you're going to be outcome-oriented for the small business owner or the individual, you really got to be outcome-oriented for the delivery of service provider. And that's people in this room like Axion, CGAP, and the intermediary sector.
Stuart, I'm so interested to hear about your work, because you said you observe people who are being resilient. So some of the people in the world who have the least amount of money, how are they managing this climate of risk just changing? There are so many facets to it, so many crises, and they have so little. Please tell us more.
Well, your very opening short video, when we started this whole thing this afternoon, gave away some of the common knowledge about that, which everybody in this room knows, because we see it every day on our television set, which is that when one of these risk events actually occurs, it's the poor who are in the front line, right? It's the poor who are lining up for food and water. It's the poor who are becoming refugees, being sent off to dismal environments. It's the poor who are suffering discriminately from heat waves, from floods. And it's the poor who die in their millions in pandemics. Now, the work I do as an observer, we do through financial diaries. And the virtue of doing these financial diaries is that we can put a little nuance on that by taking a closer look at what actually happens to the individuals involved when these things happen. So right now, for example, we're doing a set of financial diaries in Bangladesh, where we have a bunch of households whom we have been visiting every single day for the last 10 years. So we know all their transactions, we know everything that's going on in their life. So that means that when an event occurs, we know what their life was like before it happened, we watch them very closely while it's happening, and we know to what extent, if at all, they recover from it. So let me give a very brief example. We were talking about COVID just now. In 2020, when the first COVID lockdowns occurred in Bangladesh, we were able to see from our data that incomes for this group of poor and very poor diarists of ours collapsed by 76% almost overnight. How did they respond? They responded by halving their expenditure. So their expenditure, their daily expenditure per household went down from $2.50 per day per household to $1.25 per day per household. Their purchases of protein went down 64%. Their purchases of fruit and vegetable went down 55%. And things like clothing, they just entirely stopped buying for weeks on end. In other words, they responded, they tried to cope with this in a very practical, straightforward way. They simply tightened their belt. Now, that's what happens when these sharp events occurred. But there's also the question of what are things like on a regular basis, when one of these very sharp events is not happening, but they're having to live in a world of deteriorating conditions. Well, in a world of deteriorating conditions, the effect on the people who are our diarists, this group of poor and very poor people, is to make difficult lives more difficult. Simple as that. Now, some of you may have read Julie Zollman's book, Living on Little. If you haven't, I strongly recommend it. It gives an excellent account of what these kinds of lives are like, in this case, in Kenya. There is also work that's based on financial diaries. A little while ago, we were seeing the report on the WEF survey. We do something a little bit similar with our diarists in Bangladesh. Every now and again, we ask them what worries them most. And interestingly, the responses that we get are almost entirely in just two of the categories that WEF use. And those are economic and societal, because they are telling us stories about declining value of income, declining difficulty with work, family breakouts, police corruption, and all these other kinds of ills. So we also hear a little bit from them about events in the environmental category, particularly increasing frequency of floods in Bangladesh, and a little bit on the geopolitical. So in the survey we did most recently, it's to do with the outbreak of hostilities between India and Pakistan, which Bangladeshis know from their own history can badly affect them. Let me just say one last thing with another example. What we have to remember is that these kinds of pressures are not experienced by low-income people one by one. They tend to have to deal with them all at the same time. Let me give you a very practical example. One of our diarists, at the time of COVID, was forbidden by her neighbors to use the single water tap that they have in the compound that they share, because she was a casual cleaner at the hospital. And they feared infection. So that woman had to deal simultaneously, not just with COVID, but also with social isolation from her close neighbors, and she also had to face the increased costs of buying water outside.
Magda, you wrote down 3 things. What did you write down? You wrote down 2 when Shamina was talking, and you wrote down 1 when Stuart was talking.
I wrote down ecosystem when she was talking, the importance of having a working ecosystem. So it's true that, well, everybody has to work together. All the relevant actors have to work together. Each one has to do its own part. So probably public authorities have to, well, regulate, but create the right incentives for everybody else to act in the right direction. So it's true that regulation now with innovation has to move faster in a way, but I think we have to be careful to this narrative of reducing regulation, simplifying. Better regulation is good. Reducing regulation I would be careful with, because in this environment, with innovation, with some kind of innovation, if we do not regulate, we will tend to have very concentrated power rather than innovation that creates diffuse shared benefits. And then I was thinking about, well, that's so interesting, so incredibly interesting. And I was thinking, of course, of the power that well-designed financial instruments and services could do to help and create virtuous circle. So think of formal savings, well, of course, well-designed and affordable insurances, or in some cases, remittances. I think these are all services that could increase resilience. Of course, each person finds in itself what he can do. But if you can create a good ecosystem that helps developing these services, again, in an inclusive way, in a way that they can support people, then they can be able to better face even hard climate problems and all the other shocks. And they might also be able to access more easier emergency funds that sometimes the government make available. So of course, they have to be very well designed in order to be able to reach, especially the vulnerable. So those in rural areas that are hard to reach, women, less educated that might not be well equipped, or less digitally educated to use these tools, or the forcibly displaced, even harder to be reached. So let me say that all of this is relevant also for developed countries, because we think of EMD, but also in developed countries, there is a lot of dishomogeneity. So there are actually fragile groups also. Maybe they are sometimes different. So for us, it's sometimes elderly people who are not digitally equipped and tend to be excluded. Of course, poorer people. So it's relevant for all of us.
All right, so panel, I'm going to ask you to do something that is shocking, because it's going to be only 30 seconds that I'm going to give you. But it's a catalytic action from your experience of risk and resilience that our attendees can go and do. They can do with their colleagues, they can do with their communities, that will help using your vast amount of experience that you bring to this stage. Stuart.
Well, I would echo something that somebody has already said earlier today, which is that when approaching these kinds of problems, we must start with the problems, not with the solutions. And starting with the problems in this case, in my view, which is why I do financial diaries, is to understand the reality of poor people's financial lives. Because unless you understand that, how are you going to do anything that's going to improve it? Thank you.
I'll say 2 things. One, do the do the Pathfinder. I think that's something that's been enormously helpful for just building the evidence base. And then I'll give an example of where I've seen all of this come together. So building on the incredible work of the financial diaries and also the regulatory frame and frameworks from the regulators, a program that we were working with, the microfinance institution in Peru for women. Sophie brought up the unique needs of women this morning. There are things that if you have a good ecosystem going, each one can do in their own view. So BBVA is the microfinance organization. The issue that came up in the research was that women couldn't get loans without a male signatory in terms of their businesses or anything else. So we worked with BBVA to give a pass and say, hey, let's try to do it this way without having a male signer. Maybe if you need a signer, get another female signer or get somebody else to help get the loan. That intervention increased the amount, released the pent-up demand for capital. But the second thing that we learned in the research was that we didn't necessarily we followed the rule of the regulator, but these were all things inside the microfinance organization that it was implicit bias that they hadn't even thought about. The second thing was we included insurance. So Sophie talked about insurance today. We have the ability as a grantor or as a partner to say, let's try something because this is what the research is telling us that we need. We included insurance in that. We included health insurance in that. And the third intervention that we are piloting right now is childcare. So those are three things that combine the public, the private, and the frontline research in a way that says these are all things within our ability to actually make change.
Magda, what will you do with your 30 seconds?
Well, that's very difficult, but I will build on the evidence on the demand side as an economist. I mean, the final users, what they really need, and the very good practices that we've heard to share best practices among the different stakeholders. Also, I think to convince those who might provide financial support that it's actually worthwhile, because something can happen which is worthwhile for everybody, even for those who provide the financial support. So that might create a really virtuous circle.
Magda, Shamina, Stuart, thank you for taking us on a journey through risk and resilience. We appreciate you. Please take your seats again.
Thank you.